Okay, so good afternoon, everyone. Thanks for joining with us for this webinar today. So through this webinar, we'll be teaching you all on how to invest in government securities. So before we go into the presentation, three important things. Point number one is focus. So the focus of this presentation will not be like usual CAL research presentations or like an article you all would read on economics. So we are not going to focus majorly on macro developments, but the focus of this presentation will be to the investors who are new to the market and also who are already in the market about a little bit more detailed explanation about the products. Point number two, I'm not really good at putting down slides and presentations. So most of the slides that I will discuss today will have very minimal numbers or descriptions on the screen. I'll be doing most of the talking. So over the next 20 to 30 minutes, you are stuck with this monotonous voice. I really apologize for it. I wish I could explain it like Morgan Freeman, but you all will be stuck with this voice for the next 20 to 30 minutes. So please bear with me. And point number three, I am trying to put the explanations as simple as possible so that everyone would understand what these products are. So for most part of the presentation, the products I will be explaining will be compared to a basic fixed deposit. So let's go into the presentation. Okay, so the major three areas or the main three areas we will be covering in this presentation is about GSEC. So GSEC is just another fancy word that we use to explain government securities. So three areas we will be covering in this presentation. So first part of the presentation will be about what a government security is, and second part of the presentation is about why you should be investing in government securities right now, and third part of the presentation is how to invest in government securities. So what exactly is a government security? So as you all know, the government of Sri Lanka has its own set of incomes and expenses. And I know you wouldn't be surprised when I tell their expenses are more than their income, which is also called the budget deficit. So the government of Sri Lanka, to fund their budget deficit, uses central bank as its banker, where central bank will issue government securities. So in this case, we are talking about treasury bills and treasury bonds. So Central Bank of Sri Lanka will issue treasury bills and treasury bonds to investors to raise this money for the government. Since central bank cannot directly and individually go to each and every investor, what they will do is they will issue these securities through the primary dealer. So that's where CAL comes into play. So we will act as an intermediary between central bank and you, the investor, to facilitate you all to buy government securities. So contrary to popular belief, when you are buying into treasury bills or treasury bonds or any other government securities, you are not investing with CAL. So we are only the facilitators here. We allow you to buy these securities which are issued by the Central Bank of Sri Lanka. So the liability of your investment actually lies with Central Bank of Sri Lanka, which also brings me to the point why treasury bills and treasury bonds are risk-free investments. Central bank, as we all know, has the ability to print money and to settle debt. If it comes to a point where the investment that you made cannot be repaid by income, they always have the ability to print rupees and settle your investment. So that is why we call these treasury bills and bonds as risk-free investments. So moving into the products. So first we will be looking at treasury bills. So for the ease of understanding, I've compared a treasury bill with a fixed deposit. So as you know, a fixed deposit is a basic product where you go and place money with a bank for a fixed tenor at a fixed rate. For example, in this example, I've taken ₹1,000,000. If you invest at 20% upon the maturity after the end of a year, you will have 1.2 million in your hand. So treasury bill is nothing different. It's very similar to a fixed deposit. So you put $1,000,000 into a treasury bill, and with a 20% interest rate, you will make 1.2 million by the end of the maturity period. But the only difference here is the terminology. So when we buy treasury bills, we quote or in the market, how they quote for treasury bills is in terms of face value. So face value is nothing new. Face value is just another fancy term for maturity amount. So next time when you call up a PD or a bank and they ask you what your face value, what the face value of your investment is, it basically means the maturity amount of your investment. So that is treasury bill. And the next part is the treasury bond. So treasury bonds are slightly trickier. It's a little more complicated than treasury bills. So here what we are looking at is a treasury bond with a face value of 1.2 million. So what face value means is by the end of the maturity period, you will be receiving 1.2 million to your hand. So in this example, if you can see that line chart on the top, I put down a 5-year bond as an example. So you have your investment, which is paid today, and every year you will receive a coupon. So coupon is a fixed interest payment that you will receive every year for your investment. So for this example here, I've taken a 1.2 million of face value and a 10% coupon rate, which basically means every year you will receive 120,000 as coupon interest payments for this bond. And by the end of the 5th year, on top of your coupon, you will also receive the face value, which I said, like I said before, which is the maturity value by the end of the 5th year. So the question is, okay, so to receive this 120,000 for the next 5 years and the 1.2 million by the end of the 5th year, how much do you have to pay today? What is the value of the investment today? Which brings us to the concept of time value of money. So as we all know, so the money that you have in hand today is worth more than the money you will have tomorrow. So what you will have to pay today to receive these cash flows in the future should be calculated by discounting these cash flows to the present value. Or in other words, what we do is we do use a bond calculator to discount these cash flows to arrive at the present value. So in this bond, which I've taken as an example, the investment amount is 830,000. So if you put 830,000 every year, you receive 120. On top of that, on maturity, you receive 1.2 million. And also the interest rate is the rate at which we are discounting this instrument. And also the actual return on this bond is not the coupon rate, it is your interest rate, because in this example, you are paying only 830, but upon maturity, you are receiving 1.2 million to your hand. So in addition to that coupon, you also have a difference between your investment amount and also the face value. So that is also part of your return. So when you take all that into account, your actual interest over this 5-year period is 20%. So if you're thinking about investing in bonds and we are talking about returns, your actual return is not the coupon rate, but your actual return is the interest rate, or in other words, it's called the yield of the bond. So we have covered treasury bills, we have covered treasury bonds. We move into repurchase agreement. So there's a slight difference in this instrument. So previously I mentioned when you're investing in a treasury bill or a treasury bond, you are taking your counterparty risk, or your risk is with the central bank itself. But in terms of repo, it's basically like an investment that you make with CAL. So when we compare this with a fixed deposit, when you park money with a bank, your counterparty or your credit risk is with the bank. So if the bank goes bust, basically you lose your money. So there's no security for your investment. You're taking the risk or the credit risk on the bank. But when it comes to a repurchase agreement, if you invest money with CAL, for example, in this example, let's say you parked 1 million rupees with CAL as a repo investment, we will provide you with government securities that CAL owns, either treasury bills or treasury bonds, and this will be maintained under your name. So against your investment with us, we will provide you government securities as a collateral. In case if we fail to settle, you have the ability to sell these securities and recover your investments. So this is the only difference between a fixed deposit and a repurchase agreement, which is the collateral that we provide. Other than that, the interest rate, the maturity amount, everything is pretty much the same. Since we looked at investing in government securities, treasury bills and bonds, So what exactly is the risk? Theoretically, it's a risk-free investment, but there is always an interest rate risk and a liquidity risk when you invest in government securities. So your value of the security moves in opposite direction to the interest rate movement. So if I can put it simply, I've included in the table below. So for example, let's say you bought a treasury bill or a treasury bond at 20%, and today's value of this investment or this instrument is 100 rupees. So let's say for whatever reason, tomorrow the interest rates have gone up. The interest rates have moved from 20 to 25%. So when the interest rate goes up, the value of this investment or this instrument drops. So in this example, the value has decreased from 100 to 80. So the opposite happens when the interest rates come down. So from 20%, if the interest rate comes down to 15%, the value of your investment or the security has moved from 100 to 120. This is what we call the interest rate risk. So if you are an investor who is looking to hold this investment throughout the maturity period, if you're buying a 1-year treasury bill and you want to hold it for 1 year, you don't carry interest rate risk. And if you buy a 5-year treasury bond and if your plan is to hold it for the entire 5 years, you don't have to face this interest rate risk. But the risk is if you suddenly have a liquidity requirement, you buy a 5-year bond, suddenly in about 2 years time, you need the money back and you want to sell this bond. And if the rates have gone up at that point, you will have to take a capital loss. So if you had put about 100, if you had put about 100 rupees worth of investment and the rates have gone up, you might have to sell it at around 80 rupees. So that interest rate risk is there for government securities. But if you are a hold to maturity investor, you don't plan on selling between that period, there's no interest rate risk. And also there's another risk which is called the liquidity risk. So depending on the quantum of your investment, selling or exiting your position in the secondary market might be a bit of a difficult task, because in the secondary market, when it comes to treasury bills and bonds, the usual trading ticket size is about 50 million rupees. But if you're a retail investor who has put only about 5-10 million rupees, it might be difficult to exit your position. But like I mentioned before, if the intention of this investment is to hold it throughout the maturity period, again, you don't carry this risk. You will still get the promised interest or the promised return throughout that period. So we move into the second section, which is right now why you should be investing in government securities. So the answer is pretty much straightforward. We all invest for the safety or the safety of your investment and the rate of return. So right now, the graph that you see at the bottom is the 1-year treasury bill rates that are being offered in the market. As you all can see, I have included the treasury bill rates from 2003. This is a historical high. We have never seen interest rates at these levels, and I will give you an idea what drives interest rates. So when the inflation, as you all know, the inflation in the economy right now is at one of the historically highest levels. So when the inflation is high, what the central bank does is to curtail consumption, to make sure that you and I consume less. They will raise the interest rate so that it reduces our ability as an individual or a company to borrow from a financial institution and buy more goods and services. So that's the relationship between inflation and interest rate. So if the inflation is high, central bank will raise the interest rate to bring the inflation down. So right now, since inflation is at historically the highest levels, interest rate on these government securities are also at the highest levels. So you might question, okay, so if the government securities are this high, why aren't the banks also giving very high interest rates? So end of the day, what bank runs is a business. So if they are taking deposits from you, they will have to have the ability to lend that money at a higher interest rate for them to make profits. So given the current economic situation, even though the interest rates have gone up, individuals and other companies find it very difficult to borrow at these levels and sustain. So if the banks are lending about 20-25%, For an individual or a company, these are very high rates to borrow. So even right now, the credit or the private sector credit growth has stunted. So there is no loan growth from the bank. So banks right now do not have an incentive to raise deposit rates because their loan growth is also not that high. Because of that rate, we can see a because of that reason, we can see a arbitrage where the government treasury bill rates are significantly higher than the average bank fixed deposit rates. So if you are an investor who is just keeping money with the bank right now because you don't know how the government securities market work, this is the right time for you to move the money into GSEC. Also, if the question is between whether to park your money into treasury bills or treasury bonds, so the main difference between treasury bills and treasury bonds is the tenure of the investment. Generally, treasury bills are short term in nature, maturity is less than 1 year, whereas the treasury bond maturities can range between 2 years to even 10 to 15 years. So if you are an investor who is trying to lock in your money on a long term basis, this might be your best opportunity, because if you can buy into a 5-year treasury bond, for example, which is trading right now around 21 to 21.5%, in about 3 to 4 years, you can double your investment on a risk-free basis. So if you're investing in a bank or a finance company or any other instrument, you always have that counterparty risk. There's always a chance where the counterparty, which is the finance company or bank, might go bust. So there is a risk of you investing in long term. But like I mentioned before, central bank can always print rupees and settle your investment. And also you need to consider real returns when you make your investment. So what exactly does real returns mean? For example, as you all know, inflation right now is around 30%. Okay, so you buy a good or a service, in about a month's time, it might go up. In about a year's time, it might go up by 30% in value. If you invest into a bond at 20%, in about 1 year, it will go up by 20% in value. So you have actually made a negative real return of 10%. Your cash has gone up only by 20%. Your investment has gone up by only 20, but whereas the goods and services they are purchasing has gone up by 30. So this is what we call as the real interest rate. So right now, as you can see, the blue line, which is the inflation, is much higher than the current market interest rates. This is why we call there is a negative real interest. But the point here is inflation is not a long-term phenomenon. So right now, inflation, we expect it to reverse in about 1.5 to 2 years time. But if you are investing into a government security or a long-term investment, if you buy into a 10-year bond at 20%, for each year you will be getting this 20% return. Whereas this inflation at 30 to 40% is a very short-term phenomenon. So even if the inflation is about 30 to 40% is at 30 to 40% for about 2 to 3 years time, the remaining 7 years of your investment, you are getting a return which is even higher than the inflation rate. So that is what is meant by the real return being possible. In that regard, we would still advise, if you don't have immediate liquidity requirement, to park your money on long term into government securities. So what are the other advantages of investing into government securities as opposed to your other options, which is mostly fixed deposits? So right now, purely in terms of return, the interest return that you make, government securities pays a much more higher return than the fixed deposits, and it's also risk-free, as I mentioned before. The next advantage is there's liquidity. So there's active secondary market. There's always an opportunity. If the rates come down, you can sell this security in the secondary market and exit your position. Before we move into what capital gains are, I'll explain what leveraging is. So leveraging is not really applicable to any retail investments, but if you're investing big quantums, banks and other primary dealers have the ability to lend money to you against your investment. So that is called leveraging. So if you have about 10 million worth of treasury bills or bonds, by paying interest, you might be able to get a loan or a like a leverage on it for about 70 to 80% of its value. So that's called leveraging. And you also have the ability to make capital gains on your government securities investment. So what exactly is capital gains is what I mentioned before. So if the interest rate comes down, the value of your security goes up. So at that point, you can sell your security and make a return. So that is called the capital gain. For anyone who is thinking, okay, what about the risk of currency depreciation? So if the currency depreciates, won't I lose out on it? Won't I be better off investing this into gold or foreign currency or whatever? So we have done our numbers. So ignore all the text on the screen. Just look at those graphs. So what the blue graph basically means is, if you had converted rupees into US dollars today in 2022, and let's say you have about 10,000 USD, and you invest it at a you invest that 10,000 USD at a certain interest rate, which is we have taken the US interest rate there. So in 5 years, the return you will make on this investment by investing 10,000 USD is 11,500, approximately about 11,500 USD in 5 years. But if you had invested the same amount of money into Sri Lankan rupee denominated bonds, even after accounting for a 5% depreciation every year. So even if the currency depreciates 5% every year, by the end of 5th year, from having to invest 5,500, you will have 12,200 by the end of the 5th year, which is more than double the value of your investment. So I would like to reiterate the fact, this is after accounting for a 5% depreciation every year. So we are accounting for about 25% depreciation of the currency over the next 5 years. So even if the currency depreciates 25% over the next 5 years, you are still up on the deal by investing in rupee denominated securities. So since we have covered what government securities are, what exactly are the government securities we are talking about, and the advantages of investing in government securities, we move to the last part, which is the most important part and the most commonly asked question. So how exactly to invest in these government securities? You have two options. First one is to buy directly from central bank through an auction process. So how an auction works is, so the government has a funding requirement. The government suddenly, for example, say it requires about 10 billion rupees. So they come to central bank and tell the central bank they need 10 billion rupees. So central bank will come to the market and issue government securities worth 10 billion. So CAL, together with the other primary dealers, act as an intermediary between the central bank and the investors, facilitating investors to buy at this auction. So this is what we call as the auction process, to buy directly from the central bank. So to buy from the auction, you need to invest a minimum face value of 5 million, and it is a competitive bidding process. So where CAL's expertise comes into play here is, we give you a direction, or we give you a sense of market advice to indicate you where we think the interest rates might be, because it's a competitive process. Interest rates are fluctuating. There's always a chance you might bid at a certain interest rate. So let's say you want about 20% for your 1 year investment. You invest 20%, invest at 20%, but the bid might get rejected if central bank thinks that rate is too high for them to borrow. So CAL's expertise is advising its clients to make sure that the clients bid around reasonable interest rates, also to get the maximum return out of your investment. So this is option number one. This is the auction process. Option number two is pretty much straightforward. You buy directly from CAL. So at any given point of time, CAL holds a certain amount of securities, which are bills and bonds, to sell. And another advantage of buying directly from CAL is you can buy starting from 1 million rupees. So you don't have to have 5 million. You can start from even 1 million. And to buy from CAL or to know what rates we are offering, it's a completely automated process. It's available on our website. We have different maturities. You don't have to stick to the standard 3, 6, 12-month investments. So we have maturities for a month, we have maturities for 2 months, 3 months, 4 months. So whatever your investment period is, to fulfill that investment period requirement, we have enough and more government securities that are held by us, which we can facilitate, which we can sell to the retail investors. So which brings us to the last part. So if you want to sign up to the CAL Treasuries portal, where you will have the ability to directly bid and buy from CAL, you'll have to go to the home page under solutions, click Treasuries, sign up for the portal, and once you have signed up for the portal, you can sign up for CAL Treasuries, and from that screen it will take you to a page where you can see all the details of the investment. We will show what maturities we are holding at what rate, and it's a one-click process. From there it will take you to a buy screen where you can bid for the rate, and we will execute the deal from our end. And also we will be introducing an automated process really soon, which will allow the client, without having to contact us directly, to completely trade on an automated process. If you all are familiar to the CAL Unit Trust portal, where you can create or make redemptions through the portal itself from your unit trust account, we are going to apply, or we are going to introduce that same system for treasuries as well. This is to encourage retail investors to get involved in government treasuries market. Government treasuries market, especially bonds, have been in existence for over 20-25 years, and we rarely see any retail interest because majority of the big players are banks, insurance companies, and PDs, and we feel like retail investors haven't been educated enough for them to actually make use of this opportunity. And we also understand that these are very difficult times. People are not really thinking about investing into government securities while they are waiting in the queue to get petrol. So one thing that we thought we can contribute from our end is to make sure, as a hardworking person, you have your hard-earned money in your hand. So if the inflation or if the prices are going up by 20-30% every day, you need a reasonable cover. It might not cover the entire increase of your expenses, but still you need a reasonable cover, or you need a maximum return for the money you are holding or the investment that you make, which is right now, from our point of view, is from government securities. So I hope this presentation that we did gave you that insight and educated you and gave you the knowledge or the basic understanding of government securities. And anyone with the CAL Treasuries team is happy anytime to talk to you all and to explain this process or about the products for you all to get into the government securities market. So that's it from me. We are open for the Q&A sessions. If you all have any questions, post it on the chat box to the Capital Lines user. I will take the questions from my end. Okay, so taking questions. So first one, what are the tax implications for investing in a T-bill? So with the recent change, the only tax implication for investing in any government security is the withholding tax. So there is a 5% withholding tax that is applicable on your interest income. Other than that, there are no taxes, but I think this tax will be applicable in any other investment you make, even on FDs. Second question, what is the longest tenor I can buy a treasury bond for? So treasury bonds are issued for between 2 to even 15 years, depending on how liquid the market is. So right now, the most liquid maturities in the market are the 2-year and the 5-year bonds. But as the market becomes more liquid, there's a you can even buy into treasury bonds for about even 5 to 10 years of maturity. Okay, there's a question whether they can get the interest on a monthly basis. So it's like this. the investment is not made with CAL. Like I mentioned before, when you invest into treasury bills and bonds, the investment is not made with CAL. So we are only an intermediary. So your investment is actually with central bank, and the interest is not paid monthly. So if you buy a bill, it's a discounted instrument. So to get a 1 million maturity value on today's rate, you will have to invest about 900,000. By the end of 1 year, you'll get that 1 million to your hand. So that 900 to 1 million, 100,000 difference is your interest income. So it is not paid monthly, but upon maturity, you receive that amount. And also when you invest in bonds, what you receive on an annual basis is the coupon. So coupon is paid biannually. So for example, if you buy 10 million face value of a treasury bond, which pays about 20% coupon, so every 6 months you will get 1 million each. So for the entire year, you would have received 2 million, which is the 20% coupon. So again, to answer your question, there is no instrument that gives you the return monthly. What is the, okay, there's another question. What is the minimum investment requirement to invest in this product? So like I mentioned before, if you're buying these instruments from the auction, the minimum investment amount is a face value of 5 million. But to ensure there is enough avenues for even retail investors to buy into government securities, CAL has ensured that directly through the secondary market, we can facilitate investments even starting from 1 million rupees. So what are the rates right now? So right now what we are offering is 19.5 on 3 months, and 20% on 6 months, and 21% on 1 year. So these are the indicative rates. Depending on your quantum of investment, you might be able to negotiate and get a better rate. And also these are the standard maturities that we quote, 3, 6, and 12 months. So if you have an investment requirement for about 4 months or 5 months, so that also we can facilitate. So we have treasury bills maturing throughout the year. Can we instruct transfer cash from any UT funds? Oh yeah, that can be facilitated. So that can be internally done. So if you already have a UT fund with us and you want to buy a treasury bill or bond, you can simply do the transaction with us and instruct the UT to make the settlement amount. So that can be facilitated. Can a foreign passport holder invest in T-bills? If you're a foreign passport holder, you can still invest in T-bills, but the only difference from a local investor is that you will have to bring your money in through a IIA account. So you'll have to open an inward investment account with one of the commercial banks and bring the money in through that account for the investments. But to answer your question, yes, as a foreigner, you can still invest into local government securities. Is it possible to come over to your office to buy the treasury bill or bond? So this is where CAL has completely made things easy. You don't have to visit our office premises to open accounts or to invest in securities. So these securities are scriptless securities. So there's no paperwork involved. So once you log into your portal account, you can open account with CAL. And once you open account with CAL, the transaction can be done online. So you do the bank transfer, you do the bank deposit, send us the transfer receipt, and we will credit this security under your name after we create a CDS account with central bank for you. So central bank will send you a confirmation saying that you have invested this amount of money on this security. So you don't really have to visit the office premises. It can be done completely online. So if you so the question is, if you do the transaction online, what is the documentation proof you get? So two things. Once you do a transaction online with us, which basically means you do a bank transfer, a bank deposit, you send us the receipt and we execute the transaction from our end. By the end of the day, you will receive a contract note, which is a confirmation from CAL saying that you bought this amount of securities at this rate from CAL. And also on the settlement day of this transaction, central bank directly sends you an email and SMS saying that you have been allocated this amount of securities under your name. So you get a confirmation both from CAL and also from central bank for your investment. If the question is about the safety or the security of investment, I think there are multiple ways that we can ensure that the transaction has been completed. You can even directly contact the dealing room to double check whether the transaction has gone through. And also there is something called the Lanka Secure Account, which is an online platform central bank has provided for the investors. They are like any other bank account, you can log into this account and check your investment balances with central bank. Is it better to invest with CAL or to go through a bank primary dealer? So let me put it like this. Us being a non-bank primary dealer, this is our only business. This is the only thing that we do. But generally for a bank, this is only a part of their business, primary dealing. And mostly if you take banks, they don't highly encourage retail investors also, because from their end, they actually manage very high volumes from big high net worth investors, insurance companies, and big funds. But when it comes to non-bank primary dealers, in addition to managing these big funds and insurance companies and high net worth individuals, we also have our own set of retail investors, and our expertise also lies in managing clients. If you take the CAL group as a whole, we have different parts of the company, even the UT, which has its expertise in managing retail clients. So that knowledge is shared between the group. So why I would say the reason for coming to CAL over going to a bank is you will receive a more personalized and better service as a retail client if you come through CAL. If you invest on a 3-month T-bill, can be set up for automatic renewal. So there's no, unlike a fixed deposit, there's no automatic renewal in this process. If you want to invest again into a treasury bill or a treasury bond, you will have to reinvest at the next auction. But upon maturity, you will always receive an instruction from CAL, or someone from CAL will contact you saying, okay, there's a maturity coming up, would you like to reinvest this money? And at that point, depending on the interest rate and your liquidity requirement and your preference, you can decide whether you want to actually reinvest your money or not. Whereas in a bank deposits, generally it's rolled over at whatever interest rate there is on that day. Where do you see the treasury rate going in the near future? So it basically comes down to a interest. So the question is on an interest rate call. So right now, if you are a hold to maturity client and you don't have a liquidity requirement, so if you don't think for the next 1 to 2 years or whatever, you will need this money back, we would still advise or we would still recommend to invest at these levels, because these are historically highest levels. And to be very honest, 20% on a 2-3 year investment is a very decent rate. And if you can get the same rate on a long-term investment, even better. So if you are a hold to maturity client, we would still advise you to get into treasury bills or bonds. But interest rate fluctuations are there. The path where the economy is headed or the macro developments that might take place are evolving day on day. So I don't think at this point anyone can clearly say, okay, this is exactly what is going to happen over the next 1 to 2 months or 2 to 3 months, because there are certain developments that are happening every day. So if you're a trading client, if you want to buy and sell these securities, you will have to bear that interest rate risk. We have seen interest rate volatility is about 4-5% over the last 1 to 2 months. So interest rate volatility is ranging 4 to 5%, used to be like complete interest rate cycles back in the day. So back in the day, over 2-3 years, interest rate moves by 5%, but we saw that same movement in about a month or two recently. So I would still advise, if you are a long-term or a hold to maturity client, to still invest at these levels, because these are good levels to invest. Also on the tax front, the withholding tax of 5% that is applicable from October for investments. Are these rates after your fees? Okay, so there is a fees that is applicable when you bid at these auctions. So if you're buying directly from CAL, to ensure there is enough retail demand for this product, to make sure that the retailers also get involved in this process. When you buy from the secondary market directly from CAL, we are not charging anything directly from the clients. But if you are going to the auction through CAL, right now our charges are 25 basis points for a treasury bill investment, which is below 50 million. If it is above 50, it's 10 basis points. And if you're a treasury bond investor, below 50 million, we charge 10 basis points, and above we charge 5 basis points. But again, if you're directly buying from CAL, from the secondary market, there's absolutely no charge for you to buy directly from us. Okay, I think that's about it. We have covered almost all the questions that we received. And by the end of this presentation on the chat, we will be sharing the link to sign up with CAL through the CAL portal, and then through the portal with CAL Treasuries, where you can directly start trading government securities. If you have any further questions, please feel free to contact us directly. We will also share the email address of the dealing team, where you can directly contact the dealing team if you have any questions or requirements regarding investing in government securities. All right. Thank you everyone for joining with us for today's webinar. Hope you have a good day. Thank you.